$450 million. That is how much venture capital poured into Builder.ai, a London startup that promised artificial intelligence could build custom software for a fraction of the price. At its peak, the company claimed a valuation of $1.5 billion. Microsoft invested. The Qatar Investment Authority invested. The pitch was elegant. Describe your app in plain language, and Builder.ai assembles it automatically. Development costs drop 80%. Venture capital poured in. Enterprise clients signed contracts. The company expanded across continents, hiring aggressively, projecting confidence that software development had finally been solved by machine learning. Then came the audits. By February 2025, the CEO had been removed. Revenue projections were overstated by 340%. The company's lender seized $37 million from its bank accounts overnight. 4 months later, Builder.ai filed for Chapter 7 bankruptcy. The SEC and the U.S. Attorney's Office opened investigations. This is not a story about a startup that ran out of runway. Builder.ai had nearly $500 million in capital. This is a story about a structural lie, a belief that marketing velocity could substitute for technical reality. To understand how it collapsed, we need to examine the original promise, the one that made Builder.ai irresistible. Sachin Dev Duggal launches Engineer.ai in 2016 with a thesis that feels obvious. Software development is broken. Small businesses need custom apps, but cannot afford 6-figure budgets or 6-month timelines. Traditional agencies charge too much. Freelance developers are inconsistent. The market is enormous, but the supply chain is artisanal. Duggal's solution is to industrialize it. He promises an assembly line for code. The pitch centers on modularity. Instead of writing software from scratch, Builder's platform would use pre-built components, login systems, payment gateways, user dashboards, and stitch them together based on client requirements. An AI assistant called Natasha would handle the configuration, selecting the right modules and adapting them to each project. Clients would describe their needs through a simple interface. The system would generate a working prototype in weeks, not months. Development costs would drop from $100,000 to $20,000 or $30,000. Early demos showcase drag-and-drop tools and polished component libraries. Investors see a company that could capture millions of businesses currently priced out of custom software. The pain point is real. The market is validated. The technology, at least in presentation, appears credible. The idea is seductive because it should be possible. Software does contain repeating patterns. Modularity does reduce complexity. Automation does lower costs in other industries. Duggal is not inventing a need. He is promising to solve one that has existed for decades. And the money starts flowing. In 2018, Builder.ai raises $29.5 million in Series A funding. More rounds follow rapidly. $65 million in 2021 from Insight Partners, $100 million in 2022. Then in May 2023, the Qatar Investment Authority leads a $250 million Series D alongside Microsoft. The valuation climbs past $1.3 billion. Builder.ai has crossed into unicorn territory, backed by some of the most powerful names in global finance. The capital fuels aggressive expansion. Offices open in Los Angeles, Tokyo, Dubai, and Delhi. The team grows to over 1,000 employees across 5 countries. Marketing campaigns position the platform as the future of software development. Media coverage amplifies the narrative. Artificial intelligence is finally democratizing code. Investors see momentum. Clients see credibility. The growth metrics look exceptional on paper. Builder.ai is not just selling software, it is selling inevitability. But the numbers being celebrated are top-line figures. Revenue is growing, project counts are rising, headcount is expanding. What is not being disclosed is the unit economics. How much human labor is required per project? What percentage of the work is actually automated? How many developers are manually assembling the components that the AI is supposed to configure? The valuation assumes the technology scales. The growth assumes the cost structure improves. The narrative assumes the automation is real. Behind the momentum, a structural problem is quietly compounding. The platform is not reducing the need for developers. It is hiding them. The first cracks appear in 2019 when journalists begin investigating Builder.ai's core claim. What they find contradicts everything the company has said. The artificial intelligence is not building software. Human developers are. Builder.ai operates teams of 500 to 1,000 engineers across Vietnam, Romania, Ukraine, Poland, and India. These developers manually code projects that were sold to clients as AI-generated. The AI layer, the system called Natasha, is a project management interface and a component library. It routes client requests to developers who write custom code under tight deadlines and compressed budgets. The actual AI engineering team numbers just 15 to 30 people. The unit economics are broken from the start. Projects are priced assuming automation handles most of the work. Instead, each build requires substantial human labor. Developers are paid low wages, but the volume of manual work still exceeds what the pricing model can support. Margins collapse. Quality suffers. Customer complaints accumulate. Missed deadlines become routine. Features are incomplete. Code is poorly documented. Clients who expected AI-driven efficiency receive outsourced development at a loss-making price point. There is no evidence Builder.ai possesses proprietary models capable of autonomous code generation at the scale it advertised. The platform can assemble pre-built modules, but customization, the part clients actually pay for, requires human developers. The promise was that AI would replace expensive developers. The reality is that Builder.ai employed expensive developers, rebranded them as AI, and undercharged for their work. The system was unsustainable from the beginning. Once the illusion cracked, the consequences came fast. In February 2025, Sachin Dev Dugal is removed as CEO. Investors install Manpreet Rathia, a turnaround executive from Jungle Ventures, as his replacement. An internal audit commissioned by the new leadership reveals the full scale of the damage. Builder.ai had inflated its 2024 revenue by 340%, claiming $220 million when the actual figure was $50 million. The inflation was achieved through round-tripping schemes with Indian firm Verse Innovation, artificially creating revenue that never represented real economic activity. The lenders move fast. Viola Credit, which had extended a $50 million debt facility just months earlier, declares a default and seizes $37 million from Builder.ai's bank accounts overnight. The company is left with approximately $5 million in cash, much of it locked in Indian accounts subject to capital controls. Operations are paralyzed. In June 2025, Builder.ai's U.S. holding company files for Chapter 7 bankruptcy in Delaware. Insolvency proceedings follow in the United Kingdom, India, the UAE, and Singapore. The company lists liabilities of up to $100 million against assets of less than $10 million. Among the creditors, Amazon Web Services is owed $85 million. Microsoft, one of the company's own investors, is owed $30 million. The U.S. Attorney's Office for the Southern District of New York issues subpoenas, demanding financial records and customer lists. The SEC opens a parallel investigation into whether Builder.ai misrepresented its technological capabilities to investors. A federal criminal investigation is underway. Customers face a different kind of fallout. Projects stall. Support requests go unanswered. Some clients migrate incomplete builds to traditional development agencies. paying again for work they thought was finished. Others abandon their projects entirely. The capital destruction exceeds $500 million. The revolution is over. The wreckage is measured in bankruptcy filings, federal subpoenas, and abandoned code. So what actually broke? And what does Builder.ai's collapse tell us about the next wave of AI-powered service companies? The pattern is structural, and it will repeat. Builder.ai confused a productivity tool with full automation. Component libraries and templates can accelerate development, but they are not autonomous agents. They reduce repetition, not labor. The strategic blind spot was selling the future as the present, pricing projects as if the technology already worked at scale, then using venture capital to subsidize the gap. The math is unforgiving. If automation handles less than 70% of the work, human labor costs dominate and pricing collapses. Builder.ai's model required 80% automation to be viable at the price points it advertised. The actual automation rate was a fraction of that. Every project sold deepened the structural loss. Growth did not fix the problem. Growth accelerated the bleed. This is not a technology failure. The components existed. The developers were capable. The failure was strategic, confusing a margin improvement with a margin revolution. Investors funded a vision of software that builds itself. What they received was offshore outsourcing with a chatbot interface. The industry now calls it AI washing, the new greenwashing. Companies marketing automation they have not built, pricing for capabilities they cannot deliver, using investor capital to mask the gap between promise and production. The lesson for founders is surgical. Do not sell leverage you have not built. The lesson for investors is equally clear. Audit the automation claim with technical diligence, not demo aesthetics. Ask what percentage of the workflow is truly autonomous. Demand unit economics at scale, not subsidized showcase projects. The question now is which other AI service unicorns are running the same playbook? How many are rebranding human labor as machine intelligence? How many are pricing for a future that remains years away? And when the capital runs out, how many will face the same reckoning Builder.ai could not escape?